Hello everybody, I'm CJ Arlotta, Associate Editor at Hotel Business, and we've got your number. Sponsored by Best Western Hotels and Resorts, We've Got Your Number not only provides our industry with quarterly updates on some of the latest stats and figures from research firms, it also captures input from our industry's most well-respected analysts. Now, on to the numbers. According to a recent hospitality directions report by PwC, lodging metrics continue to remain positive overall. For many hotel companies, Q1 brought about a stronger than expected increase in demand and a slightly stronger rate growth. For Q1, year-over-year RevPAR increased across the transient segment nationally. However, group RevPAR was down marginally due to a decrease in occupancy compared to Q1 2017. For additional analysis, I'm joined today by Scott D. Berman, Principal and U.S. Industry Leader of Hospitality and Leisure at PwC. Thanks for speaking with us today, Scott.
My pleasure, CJ.
Now, let's take a deeper look at how the markets have been looking this year. Scott, mind providing us with an overview of where we're at in the market now? How did the industry fare in Q1?
Most leaders use the word euphoric. Q1 was excellent. Beat all metrics by a great deal, and so we're looking at overall occupancy, and I guess the real surprise for those of us that study hospitality on a day-to-day basis was the average daily rate in the United States, which saw appreciable gains in Q1, and in fact, I think we can say the same for Q2. Those numbers have just been released.
Now, Scott, in PwC's report, there's a brief mention about current state and federal policies counteracting anticipated positive impacts coming from the Tax Cuts and Jobs Act. Could you elaborate a bit more on this?
Well, I think tax reform has been a bonus. It's given owners of hotels confidence to reinvest in their assets. It's given the brands confidence to invest in new technologies, that's very important to overall economic health for hospitality.
Compelling economic fundamentals combined with an increase of commercial transient demand suggests continued momentum in 2019. Break down the numbers for us and also point out what we should be paying close attention to for the remainder of the year.
Well, you can't talk about industry fundamentals in the United States without starting with supply. Supply has always been an Achilles for the hospitality industry in the United States, meaning new supply, new rooms coming online. And what traditional numbers don't take into account are any additions from the short-term rental crowd, aka Airbnb. So in the traditional sense, we're seeing close to a 2% supply growth, largely in a narrow stream of chain scales right in the middle, around upscale and those brands that are largely rooms only operations. And so when you have that relatively isolated supply growth, a strong economy, and the convergence of three markets, transient, group, and leisure, all gaining ground, it bodes well for a strong report, and that's what PwC's Hospitality Directions is indicating. Again, the surprise has been the growth in average daily room rates in markets like New York City, Miami, and Washington, D.C.
Scott, thanks for joining us today.
My pleasure. Thanks, CJ.
This wraps up this quarter's We've Got Your Number. See you next quarter with an update on the latest industry stats.